Hey guys, welcome to another video. I wanted to talk about put options and how they work and when they make sense and how they behave. Obviously, we never know the future and we can't predict the future, but we try to make good decisions going forward because we're trying to make money. So the S&P is up. It's up on every time frame. It's up on the monthly, big. It's up on the weekly, big. And it's still up above the 20 and the 50 moving averages, which is what I have right here showing on the chart. So I believe this market is expensive. If I think the market is expensive, how can I take advantage of a possible adjustment? If we look at let's look at the weekly chart. The last time it was expensive was around 3,400. If you put on a bear position or a put option, it would have made you a good amount of money. Okay. I'm looking to do the same thing now when it's at 3,700. Looks like it's starting to crack, right now. So let's talk about a put option. What is it? How does it work? So if you look at the S&P, right now it's about 3,700. Okay. The put option, the way it works is you're going to choose a level where you want to own or have a short position, which you can call like a negative position. And there's a premium involved for a certain amount of time. There's 3 different parts, okay? Just know that. Now, there's 2 types of options. There's ones that go up and ones that go down. So the calls are the ones that make money when the market goes up if you own them, and then there's puts. I'm only going to talk about put options. So because I think the market's going to decline, there's a bunch of things I can do. There's smarter things I can do, which I'm not going to do. I can sell call options. I can sell call spreads, which are combinations of 2 options. But I just want to talk about the very simplest way to trade options, which is the very primitive way of outright owning put options. And I actually don't think it's the best strategy, but it's the simplest to explain. So I think the market's going to go down, right? I don't know how it's going to go down, but it's going to start to break those moving averages and then be below the 50. This big chunky one that I have here is a 50-day moving average. So I think it's going to be below there, and I'm hoping that when I buy my option, it's going to increase in value, and therefore I'll make a profit. So I'm going to use the 37. I'm going to use a 37 option. So there's the 37. What that means is when I buy this option, I'm owning the downside from 3,700 and down. Okay. Now, for this example, I'm going to use the 3-month option. So let me see if I could do it in text here. Let's say I do. Hopefully that's big enough. 3,700 strike put option. 3 months, because I just chose it for 3 months. Most bear trades take between 6 months and a year to fully play out. And bear trades are a correction or more. Now, if we get a correction, you're only looking at about 10%. But so if it's just a correction, a 3-month option should be fine. If it's more than a correction, then a 6-month to 12 months might be better. And I know the cost of the option at the time when I was looking at it was 175 points. And I was looking at the mini, so which is $750. Okay, so that came out pretty good. So I have, oops, let me undo that one. So I have this put option, the 3700 strike, which is 3700 strike means from 37 down, I make money on the option, but there's a premium involved. So the premium is the price you're paying for leverage. Now you can outright short this market using like a mini futures contract. You can use the S&P shares. You can use the micro mini futures contract. And they're all different levels of leverage. The problem with those is to be in them, you have to have a certain amount of margin, and you have to be prepared to take sizable risk. So when you're in those trades, you can get stopped out. It can go up further against you, and you have to take the risk point for point until you get stopped out. The reason I like options, it's because it's a very good way to put on a stubborn trade. Like if you want to be able to hold onto the trade, you can't get stopped out, this is the way to do it. Your risk is defined. You can't lose more than what you pay for the option. In this case, I'm looking at the mini micro, which is $5 per point, which means it's, let me calculate it because I'm not going to do the math in my head. So it's 18,500 worth of equity. So I'm using a kind of a decent size option, which is the at the money option. The 3,700 would be considered at the money. If it's like 38, 39, it's considered deep in the money, the put option. And if it's further out, it's out of the money. And I'll talk about why that matters in a sec. But all that premium, because there's no meat, there's no intrinsic value, it's kind of a junky option, but it's $750 to control 18,500 worth of equity. So the 175 points, that's what it costs, times 5. I keep bringing up the 175 because we're going to add it to that line. So the 3,700 is not where we really make money on expiration day. Worst case scenario, if I have to hold this option for 3 months until expiration, I have to factor in the premium because that's going to be like a rent that it evaporates. So that's almost 200 points, 35 and 25. So let's go 35. There we go. So those are my two lines. One is my strike and one is my break even. When you buy an option, you really hope it moves fast. You're betting that the move is going to move faster than the premium value per day, basically. You can factor in, if I'm paying $750 divided by the 90 calendar days, this option is going to lose at least $8 a day because that's the built-in premium, that's the rent. So you want the option to move in the direction you want as fast as possible. The beauty of the option is sometimes the premium gets really low relative to how expensive it can get, and you're hoping that it can blossom, it can expand, and you can double, triple, quadruple. You can make as much money as the market is willing to move. But I already put a limit to get out. I think at 250. I must have paid This must be 150, not 175, because that price doesn't sound right. 150 times 5. Yeah. So between 150 and 175 is probably the cost of that option. But I paid 750, so it's probably 150. So the idea is I pay 150. Let me move this break even since that's the case. So I want it to go as much below that line as possible. If it does it really quickly within a week, the premium has less of an issue. In fact, the premium will work in my favor because it will expand. And if the market takes longer, I just hope it's below this second line, because then I'll make money even despite the premium evaporating. Now I know it's a little, it's going to seem complex. It's going to seem hard to understand, but you need to know these factors if you're going to be dealing with put options. Some people already know this stuff, so they're going to be like, okay, whatever, no big deal. I'm not impressed. If you're an advanced trader, you're going to say that's actually a really dumb trade because there's smarter ways to avoid that premium decay. And I agree. For the sake of this video and this example, I'm not going to go into the more complicated ways. And for a swing trade, this might be enough anyway. A spread would be smarter to reduce the premium outlay. And maybe a deep in the money option. Instead of the 3,800, instead of the 3,700, maybe a 3,800 or a 3,900 would be better, because you have less premium decaying day after day. When there's more meat on the option, there's less premium evaporating day after day. There's less theta. If this market goes where I think it's going to go, then it won't really matter, and I'll be actually out by then. I'm expecting a 10% correction like we've had before, and maybe even more to that same level to retest. Eventually, we're going to test some lower levels, but we're not going to do it in one swoop. We're going to see these. We're going to pass those moving averages, and then we're going to test those support lines. So I want to be in this type of trade for that type of action. Now, if I'm wrong, then I lose the premium I paid. I'm renting the leverage, and I will lose that, and I'm willing to lose that for this trade. I shouldn't be willing to lose that, but in this example, I don't want to be, if this market just gets crazier to the upside, I don't want to lose more than that amount of money. So the idea is, I don't want to risk more than I'm willing to risk. If in this example, let's see, if the market sells off to the 50-week moving average, or just to like right there, that's 20%. But at 10%, you can make a lot of money just trying to catch a 10% decline. Let me just show from 3,700, a 10% decline would take us to 3,300. So that's a 400-point decline, a 400-point decline in that option. 37 with a 400-point decline would be 3,300. So it would be worth 400 points. If it does it quickly, it'll be worth maybe more than that. So it would at least give 100% return, which is pretty good. That would be a 10 times. If it moves 10% and you get 100% gain, that's 10 times leverage. So that kind of tells you that the power of using a put option when you're 100% right in the right direction. That doesn't always happen. When you're trading a put option, you want to use the assumption that you're going to be less than 50% correct, because you're choosing a direction. When you're trying to pick a direction, you're never going to be more than 50% correct. You have to factor that in, because being early is also a form of being wrong. When you're investing and trading, you need to factor in time in your direction calculation or thesis. And especially with options, there's a huge penalty for being early, which is the same as being wrong. I don't recommend buying options outright. I think there are smarter ways to do it, but this is a very easy and simple way to try to take advantage of a decline in the market. And it's a good time to do it because it's starting to wobble. I think the Dow Jones, let me see if I can pull it up. That one's a cleaner example of it just looks heavier. And then also VIX today, it's up 15%. So there are cracks in the foundation that could lead to a potential 10% correction. There's the Russell was down early, more before, but that's all I have right now. If you have any questions or would like more follow-up information, let me know and leave comments, and I'm happy to answer any questions in the comments. Cheers.